BlackRock is the world's largest asset management company with trillions of assets under management, and today we're looking at 5 big buys they've made in Q3. We're going to take a look at every single one of these companies, looking at their performance. We're going to take a look at their dividend safety as well as their financial metrics, and as always we will run them through our own stock valuation model, getting to our own intrinsic value and our own acceptable buy price for each company that BlackRock are adding to their portfolio. Now what we can see, we'll jump straight into the first company, and the first company that BlackRock have purchased is Kenvue. Now this, formerly the consumer healthcare division of Johnson & Johnson, they added around 91 million worth of shares, and we can see this has increased their position quite significantly by over 1,000%, with their average buy price at around $23.4. Now when we take a look at Kenvue, we can see this price is effectively lower currently than what BlackRock have purchased on average, and we can see over the last 6 months this company has been hammered down 21% since the spin-off from J&J. It is trading towards the mid to lower end of that range, and now when we take a look at some of their metrics, it does offer a yield of just below 4%, dividend safety score of 70 with a market cap of 39 billion, so it is effectively a large cap company. Now when we do take a look, typically we look at the recessionary metrics, but given this is just spinning off in the beginning of the year, we don't have too much to talk about on there, and same with these metrics, which we will cover on other companies. Now, given we always tend to look at the free cash flow, this is one that we continue to focus our attention on, as earnings is susceptible to manipulation by management through accounting. Now the data will show us for the last 12 months 16%, and for the forward next 12 months 64%. Personally, I like to see this at 60% or lower. It does give me faith that management have that ability to offer double-digit increases, but again, this is a fairly new company. Now in terms of their free cash flow payout, we do see it sitting around $1.27, $1.25, and growth over the last few years separated from the Johnson & Johnson business. We can see around 4% increase in 2021 with a decrease in 2022. Again, this data will be very limited. It will be based on the separate business of Kenvue as opposed to Johnson & Johnson over the last few years, but we can see it has moved very marginally over the period. Now, in terms of the ROIC for the last full year, 2022, it is sitting around 13%, which is above that 10% I typically say on the channel as a minimum. We want 10% or more. It gives us faith that management are able to effectively allocate their capital. And for the last 12 months, the free cash flow margin sitting at 16%, above the 7% we target. Very positive to see. And again, with the operating margin for 2022 and the last trailing 12 months, 20%, again above the 16%. So that is something I like to see. Now, net debt to EBITDA, this does correlate to essentially dividend safety. Below 4 is what we look for the consumer staples, and we see here it is significantly below that. This essentially signals the number of years it would take the company to pay off all of their debt net of cash on hand. So I can see why we are seeing that this dividend for Kenvue is safe. Now, when we take a look at the essential valuation model, and as always, typically what we do on the channel when we do a deep dive is we run through all models: Graham's valuation, multiples valuation model, dividend discount model, DCF model, to get to our intrinsic value. However, for time purposes, we will jump straight into our intrinsic value. And as always, it is just the average of the models we run through. Sometimes for different reasons, which we discuss throughout the episodes, we tend to avoid some of these valuation models due to it not being relevant, and we do discuss why on those videos. Now the current price is sitting at $20.44. We have an intrinsic value of $24. Now typically margin of safety, what I would start off with would be 10% if we believe it has a wide moat, strong financial metrics, good forward looking data. So at 10% your acceptable buy would be up to $21.80. 15% margin of safety, it would be a buy up to $20.59. So roughly at the current trading price. So it does signal that right now, if you were to add Kenvue, you would be locking in around a 15% margin of safety based on our estimates. And Wall Street, well, they forecast the price to go roughly in line with our intrinsic value at around $24 over the next 12 months. So they do see around 20% upside. So based on this, we are saying that right now you are locking in on our estimates a 15% margin of safety with around 20% upside per Wall Street forecasts. As always though, we never listen to what Wall Street do, and we always have to do our own due diligence. So we then move on to the second stock that essentially BlackRock have been buying, and this is Blackstone. As we can see, Now, it is essentially a private equity business, and we can see they bought around 10 million worth of shares, increasing their position by around 30%, and we do see their average price roughly at around $80, so they are up around 40%. As we saw with Kenvue, they are currently down. So when we take a look at Blackstone, we can see year to date it is up around 48%. It is trading towards the mid to upper end of the 52-week range and does offer a yield trading 12 months of around 3%. Now, investors who have been holding this company over the last 10 years would be up a very strong 303%, although you can see it did hit its peak towards the back end of 2021 at around $147. Now, when we do a quick analysis, we see the dividend safety score currently sitting at 45. It is borderline safe. Market cap around 80 billion, so it is a large cap company. Now, in terms of recessionary metrics, well, they didn't in fact pay a dividend during the recession, so we have no data. And we see here the recession sales an incredible 825% negative, which was well below the average growth of companies in the S&P 500, which was negative but to a much smaller degree. Now, dividend growth, nice to see, 8% above the 4% we advocate on the channel to beat up or keep up with inflation. Last 10 years, double digits, very strong to see. Last 10 years, double digits, again, 20%, so very, very, very nice to see as a dividend growth investor. But do note they have had a few dividend cuts, hence they have only been paying increasing dividends for the last 4 years or more. Now, in terms of dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have a sign here of overvaluation as the 2.95 below the 5-year average of 3.63. But remember, we don't look at any of these models in isolation. Forward P as well above the 5-year average, so another sign of overvaluation. And when we compare it to the sector P at 10.7, Blackstone's is sitting significantly above that, right there at the 52-week high. But as always, it is imperative to understand that 52-week high is never an overvaluation signal. Now, when we take a look at the free cash flow payout, we do like to see below 50% in particular for asset managers, and it does seem to be quite above that over the last 10 years, especially over the last 4 years. So that is one to keep an eye on, although in 2022 it was around 53%, with 2023 expected to be lower, around 40%. Free cash flow per share, well, $6 in 2013, $8.24 in 2022, so it is nice to see it has grown over the last 10 years, but there are a lot of inconsistencies. As you can see, it has decreased all the way down to 2017's negative 2.48 before picking up, so something to bear in mind and understand the type of company you are investing in. Sales growth now double digits is very nice to see, but it is very cyclical. We see a couple years of double digits followed by a year of negative double digits, and so on the pattern does continue. But numerically speaking, we do see an increase on the top line of 6.5 billion to 8 billion in 2022, and we see 2021 in fact, yes, as a very strong year. Shares outstanding, well, they do the opposite of what we'd like to see. We love it as investors when companies do share buybacks, returning excess cash to shareholder pockets, and we can see they have done the opposite where they have issued shares quite a lot and diluted the position of a shareholder, moving from 591 million in 2013 to 741 in 2022. Now, ROE is a lot better metric to look for asset managers than the typical ROIC we tend to look for. Above 25% for asset managers is our target. Again, very inconsistent. Some years above that or even in line, but we see 2022 significantly lower at 14%, with 2021 at 68%. Now, when we take a look at free cash flow margin, above 20% for asset managers. Now, it is nice to see that over the last 4 years it has been around there or significantly higher, but even before that there are some years of negative free cash flow, so it is one to keep a close eye on if this is your investment. Net debt to EBITDA, remember what that stands for, below 1.5 for asset managers. The last 3 years it has been below that, although do note it is expected to creep up slightly higher in 2023, and we can see why now that dividends does seem to be borderline safe. Now, when we take a look at the valuation of this company, what we can see for Blackstone is that, as always, the average is just the 3 models we've gone through as the average, 133.45, current price at around 112. So when we do start off with 10% margin of safety, we do get an acceptable buy up to $120. 15% margin of safety, it is essentially right now at this current price. So Blackstone, if you were to add up to $113, you would be looking at a 15% margin of safety. And we can see here, in fact, Wall Street believe right now the current price is essentially the fair value. They don't believe it will grow any further over the next 12 months. So that is just something to consider. Whilst we see around 10 to 15% margin of safety, Wall Street are effectively saying that this is the current price they believe the share price to be over the next 12 months with zero growth. We then move on to the third company that BlackRock are buying, and when we take a look, we can see that is Extra Space Storage. Now they have added around 7 million worth of shares, increasing their position by around 53%, and we do see their average price at around $101, so they are up around 29%. Now when we take a look at the company year to date, it is down around 10%, trading in the mid-range with a forward yield of around 5%. Now, investors who have been holding the company over the last 10 years would be up quite a significant 207%, especially considering that the all-time high was nearly half the current price at around $227 at the back end of 2021. Now, we can see the dividend safety score is 80, so that is nice to see, with a market cap of $27.5 billion, making a large cap company. Now, some key metrics. Well, in the last recession, they did in fact cut the dividend. They had roughly flat sales, as always, that it was above the average growth, but they did underperform the S&P 500 with a negative 66 return as opposed to the S&P's negative 55. Nice to see this dividend growth. I do like seeing this. 8% this year, double digits over the last 5 years, and a very strong 22% over the last 10 years. Love to see that. And they have been paying increasing dividends over the last 13 years. Now, dividend yield theory, what we can see, we have our first sign of undervaluation as 4.98 is above the 5-year average. Forward P to FFO sitting below there, so again, very nice to see two signs of undervaluation. And we do note that is slightly higher than the real estate P to FFO of 13.3. Now, as always, for REITs, we look at the adjusted funds from operation payout. And in 2022, this sits at 67%, which is below the 90% we see for REITs, which is why we can see those very nice double-digit increases to the dividend. Now, adjusted FFO, well, 212 in 2013, 890 in 2022, so very strong to see more than 4 times growth over the last 10 years. Sales growth for REITs, 5-10% is what we're aiming for. Nice to see nearly double-digit growth every single year over the last 10 years. 2022, we see 22%, so that is nice to see, as well as 21. So when we look at that numerically speaking, it has gone nearly 4 times growth from 530 million in 2013 to 1.97 billion in 2022. Now, I actually really like to see this. A lot of people will be saying why you like to see this, especially when the shares outstanding is going up and down. Well, it is very typical for REITs to issue shares and dilute your position as a shareholder. The main reason for this is they retain little of that internally generated cash flow after paying dividends. But one of the reasons that I like this more than other REITs is due to the fact that you will see a lot of share dilution over the last 10 years from many of the REITs that we analyze on the channel, whether that's Vici, whether that's Realty Income. So 113 to 142 is actually pretty decent as a shareholder. ROIC 3 to 5% is what we aim for when we look at REITs. Now we can see this has been well above that, and on top of that, I love to see this increasing. It does show that management are able to effectively allocate their capital and are improving on this every single year. Now when we take a look at the operating margin, very nice to see this is also increasing from 42% to 55% in 2022. And finally, the net debt to EBITDA, one of those metrics, remember it does signify an impact to that dividend safety. Below 5.5. Now 2022 it was around 5.47, touching the border, but it is expected over the next 12 months to come significantly lower. So that is quite positive. And then now when we jump into the valuation for Extra Space Storage, remember as always the intrinsic value is just the average of these models. And if you do want to grab a copy of these models to run your own company through to get your own intrinsic value and acceptable buy price, just click on that pinned comment below and you can go ahead and start. Now, intrinsic value for EXR is coming to $150. Now, if we start off with our margin of safety at 10%, we can see here that this is coming to $135. So you can already tell that you are probably locking in between a 10 to 15% margin of safety at the current price. Now, what do Wall Street say? Well, they believe the share price to go up slightly lower than our intrinsic value, up by around $10 to the current trading price. So whilst they do believe it to be a buy, they see a little less upside than our calculation. Now we're jumping into the essential fourth stock that BlackRock are buying, and it is Airbnb. Now, for those that don't know, it is effectively an online marketplace for short and long-term home stays and experiences. They've bought around 7 million worth of shares, increasing their position by around 36%, and they are currently in the red, down around 9% with their average buy at $139. Now, when we take a look at the analysis of Airbnb, we can see that year to date it is up around 49%, far outperforming the S&P 500 up around 17%. It is still, however, trading in the mid-range, but it doesn't currently offer a dividend. Now, investors who have been holding the company over the last 5 years, you can see the starting price was around $68, so you would be up nearly 100% on your position. Now, taking a quick look at some metrics, 81 billion, there is a large cap company. And when we take a look at some metrics and data, we can see their free cash flow has had a bumpy ride. It went from 59 cents in 2017 all the way down to negative in 2020 due to COVID, and then it did bounce up to 5.35 in 2022, with the next 12 months showing some nice signs of an increase on top. So overall, it is moving in the right direction. Sales growth double digits every single year other than COVID, which I do believe you can justify due to a lot of lockdown, a lot of people staying in their own homes due to no other option. So this is very positive to see. It did rebound quite nicely from 2020, so it is a positive sign in my opinion. And the top line has increased nearly 4 times from 2.56 billion in 2017 to 8.4 in 2022. Now, this is one thing that I don't like to see. Obviously, you can understand why. It has gone from 255 million shares to 680, so your position would have been significantly diluted by these share issuances. Now, ROIC, given the fact they have made a loss, we do see in 2019 and 2020 be negative, although 2022 has come at a very nice 24% above the 10% I aim for, and the trading 12 months at 20% showing some good signs for this company moving forwards. Now, operating margin and free cash flow margin, we can see a slightly different story. They have struggled on the operating margin for quite a number of years, but they have picked this up to 23% in 2022. So I would look to 2023 guidance and 24 to see whether this is something they can maintain, as you don't want to be investing in a company that continues to have negative operating margins. Free cash flow margins over the last few years, very strong to see, double digit, and if this does continue, then this could be a very strong company for the future to invest if you believe in the whole premise of Airbnb. Net debt to EBITDA, essentially showing them that they have a very strong balance sheet, and in 2022, it wouldn't even take them one day to pay off all of their debt net of cash on hand. So let's jump into the valuation for Airbnb. And as always, if you enjoy the content, value is being provided, do smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So we're getting an intrinsic value of $188. Now, margin of safety, when we start off with 10%, it is a buy up to $169. At 20%, it is a buy up to $150. And if we get to 30%, we still see it as a buy. So you are roughly locking in between a 30 to 35% margin of safety. I know a lot of people on the channel would probably not even be interested in this due to the fact that it doesn't pay a dividend, but it does look to me like it is fairly undervalued. In terms of Wall Street, well, they believe the share price to go up by only around $12 over the next 12 months. So there is also that to consider. But as always, do let me know your thoughts as we go along this video in terms of whether any of these companies you are looking to pick up or have picked up over the last few months. This takes us on to the last company that BlackRock are buying, and that is Eli Lilly. Now, Eli Lilly, they have essentially purchased around 1.2 million worth of shares, increased their position by around 1.9%, and we can see they are significantly above their current average price of $114 by over 400%. So let's take a quick look at Eli Lilly. This company is up 62% year to date on a phenomenal run right there towards the 52-week high with a yield of just below 1%. Now, investors who have been holding this company over the last 10 years would have been on an incredible run over 1,000%. So let's take a quick look. The dividend safety score 96, very safe. Market cap 500 billion. It is a mega cap company. And if we look at some recessionary metrics, well, they increased the dividend during the 07-09 recession, plus 4% recession sales, so above the average growth of companies in the S&P. And they did slightly better perform the S&P by negative 49% versus negative 55%. Very, very nice to see double-digit increase last December, which means that we are expecting an increase this month, and we would love to see another strong double-digit increase. Last 5 years, 14%, very nice to see. Last 20 years, a little bit mediocre when you do compare it to the previous data. Now, in terms of dividend growth, they have been paying increasing dividends over the last 8 years, And when we do take a look at dividend yield theory, we can see a massive sign of overvaluation with the yield well below the 5-year average of 1.64. Likewise, with that forward PE, an incredible 53 right now. Now, in terms of the sector P, it is significantly lower at 16.5, but always do remember, just because a company is towards the 52-week high, it is not a sign of overvaluation. Now, free cash flow payout, remember, below 60%, we want to see those increasing double-digit increases. 2022, slightly higher than I would like at 77%, although the next 12 months is expected to come down to 53%. So I would like to see between a 10 to 15% dividend increase from Eli Lilly this month. Free cash flow per share, $4.29 to $5.10. It hasn't had the greatest growth over the last 10 years, and we do see a lot of inconsistencies with decreases followed by increases, so something just to bear in mind with this company. Likewise, sales growth, it hasn't had strong double-digit increases every year. We do see some years of double-digit negative growth, as well as some years of single growth and single negative growth. So numerically, this translates to around $23 billion in 2013, $29 in 2022. One thing to note, though, it is nice to see that they do return excess cash to investor pockets by doing share buybacks. $1.08 billion in 2013, $905 million in 2022. And when we take a look at their ROIC, well above that 10%. In fact, over the last few years, in the high 20s to low 30s. So that is a very strong commitment and faith to management that they are doing a very good job. Operating margin well above the 12% we look for. Free cash flow margin well above the 5%. Although do note the trailing 12 months has decreased, so something just to keep an eye on. Finally, net debt to EBITDA well below the 3 we look for companies, 1.5 in 2022, and it is expected over the next 12 months to come down even lower, so we can see why that does have a very strong dividend safety score. Now, the valuation model, let's jump into it. And remember, if you do enjoy the content, value is being provided. Smash the like button, let me know you're loving the content. Subscribe and hit the bell so you are continually notified of these videos as they drop. And as always, if you want to grab a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio or on your watch list, do click on that pinned comment below. So the current pricing at $591. Now, typically with strong companies that do trade at premiums, you would look to see a margin of safety of 10% if you believe it has a wide moat, strong financial metrics, good forward-looking data. Even with that, we can see that essentially Eli Lilly is trading at effectively a strong premium, because at 10% it is a sell up until $57 or $576 in fact. So really right now, if you were to add this to your portfolio, you would be getting a margin of safety of 5%. What do Wall Street say? Well, they believe over the next 12 months the price to increase pretty much in line with our intrinsic value. So they do see some nice upside around $50 per share. But based on our analysis, you are only really locking in a 5% margin of safety. As always, let me know your thoughts in the comments below. Are any of these companies ones you're adding to? Any of them that you're surprised that BlackRock are adding? Or just your general thoughts of this video, and if you want more of the same. As always, if you enjoy the content, smash the like button, hit the subscribe and bell so you are continually notified of these videos as they drop. And don't forget, pick up a copy of the valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio by clicking that pinned comment below. And if you'd love to join us in the Discord, then do click on that Patreon link below, talking all buys and sells in the market. As always, have a great day, catch you on the next episode, and take care.